Welcome to the What to Watch video update. This is the last video that I do over the weekend where I go through all the charts that we've been looking at throughout the week, and I pick out those charts that seem to be saying something right now, and then I put them into three categories: positive, negative, and just those charts that have an impact on the market, but we're just watching for right now. Now, we're looking pretty negative these days. We have all of the major indexes, at least the ones that I follow, the Dow, the NASDAQ 100, the NASDAQ, the S&P, mid caps, small caps, they're all negative. We've all crossed with a moving average crossover to show that we're in a downtrend, but we're not officially in a bear market. That won't happen unless we fall 20% from the all-time closing high set on February 19th. If that happens, then we're not only in a downtrend, but now in a defined bear market. But we're still hanging on to being in this corrective area between 10 and 20%. We have some positive things that we can hang on to. Some of our indicators are looking okay for right now, but the list is quite a bit longer when we look at the negative side. So, first going through the positive areas, just in Thursday's session, and we had a holiday shortened week, so the last trading day was Thursday. The S&P did see enough of a gain here internally to have the McClellan Oscillator go back above zero. Not by very much, and we could have a slight down day in the upcoming week and send this back below zero, but at least for right now, this is looking a little more positive. And we look at the Swenlin Trading Oscillator, which is going up based on price and volume. That's positive, and both are above the midpoint. So that's rather encouraging there. And we're just barely turning back up. When the McClellan Oscillator is positive, well, we're starting to turn up, even though it's really hard to see based on price. And we're trying to turn up here based on volume with the summation index. And the bullish percent indexes, these measure the point and figure buy or sell signals inside of the S&P. We had been seeing a whole lot of sell signals. Well, we finally got to an extreme negative reading, and so far we've been bouncing up out of that, and we're above the moving average. So this is positive. When we look at longer term support, now not this past week, but in previous weeks, as we were really screaming to the downside, we came right down to this 50% Fibonacci retracement level. That goes from the 2022 low to the 2025 high. And so far, we're up above that. In fact, we're even back above this 38.2% retracement level. So this shows that a little bit longer term support is holding, and really long term support is holding for right now. If we break down and fall back below this 38.2, that's going to be more negative. And since we already came down to this 50% retracement, in a positive environment, we come down here for a very short stay and then bounce up out of it. And so far, that's the case. Now, if we do come back down here and double test it or actually fall below it, yeah, things are going to be turning a lot more negative at that point. This is another look at long-term support. Even though we lost this pivot level here, this is a weekly chart of the S&P. We did come down and we held at this S1 level. We did drop below it when we had that deeper move down, but then we were able to come back above it. And so far, we're back above this S1 level. We're still below the pivot, but we're above this S1 point here. And so that is holding as longer term support. If we start to go up, we'll be watching the 55.75 level right around there. That may provide overhead resistance if the S&P tries to go up. And this is a trend channel going back to 2009. We're still above the midpoint. That's holding. And this is another trend line going from the October 2022 low to the October 2023 low, and then extending that trend line forward. We came down, tested that level, had a short stay here, and have been able to bounce above it. Now, if we come back down, that's going to change the context. For right now, though, this is long-term support that's holding. And even though the VIX is still very high, we're above 20, so that's negative overall. We have been coming down with the VIX enough to shift the momentum as measured by the MACD to down, which ends up being positive for stocks. As the VIX is coming down, that means stocks are going up. And the momentum of the NASDAQ 100, even though it's now in a downtrend, we saw enough of a bounce here to see the PPO, which is used to measure the momentum. It is above the moving average. Not really strong, but it's still positive. And we look at a ratio between the Qs, which is the NASDAQ 100, and the small caps. This ratio is still doing quite well. Now, there's really no strength in this ratio right now because the Qs, the NASDAQ 100, they're in a downtrend, but the small caps are doing even worse. And so that's what's causing this ratio to go up since the NASDAQ 100 is holding up a little bit better. But still, this is one of these bigger picture charts that we look at. If you go back to the dot-com boom and then ultimate bust in the year 2000, we saw this whole ratio just fall apart. It's not falling apart right now, so that's more positive. The financials, now they're struggling too with a lot of other areas of the market, but when we do a ratio of the financial sector to the S&P 500, it's holding up quite a bit better, and that's more encouraging. And then we look at the NASDAQ 100 to the Dow, holding out right about at this red line here. If we were turning even more negative, this ratio would be going down. Now we have a pretty long list of negative things. And I don't know what's going on with this. We used to get this updated every week. Now it seems to be every 2 weeks when I get this chart updated. But this is called investors intelligence. And these are people that make recommendations out there. Buy this, sell that, we're going up, we're going down. Well, when you take all of their advice together, they are extreme negative under one right now. And now that's negative in and of itself, but this could end up being positive because you can see other times when we get really extreme negative, we can use that as a contrarian indicator. But we've had other sentiment gauges that we've been using that are extreme negative. So we think, okay, we'll use this as a contrarian indicator right now, meaning the market could go up. But these indicators have just been sitting here. And this is like the third week in a row. We've had a really low reading with this particular indicator. Now, for 8 weeks in a row, individual investors are very bearish on the market. That's not usually what happens. Usually they freak out, which when I say they, I mean us. Anybody watching this video is an individual investor. And usually it just lasts a short period of time. It's a climactic period. It's a washout in the market. And we come down, everybody's freaking out, and then we bounce up out of it. Now, we've been camped down here for 8 straight weeks. Also, another sentiment gauge is we're actually improving a little bit, but we haven't even got back up to 25. Usually when we're at 25, that's showing extreme fear, and then we use this as a contrarian indicator. But for pretty much most of March, we dipped a little bit above 25 March, and then most of April so far, we've been below this 25 area. So people are just remaining pessimistic and just staying that way. The VIX is coming down, but it's still above 20, as I pointed out earlier. So it's still negative overall, but at least it's declining. And we're going down with the risk on to risk off ratio. In a more positive environment, this ratio would be going up. In a negative environment, this ratio is going down, which is what it's doing now. This is also another type of risk on, risk off ratio, high beta versus low beta. High beta, are the stocks that tend to outperform when we're doing well. The Apple, Microsoft, Nvidia. Well, they also tend to go down faster when we're under pressure. And we see folks getting more into the low beta stocks, which may not go up, but they go down less than some of the high beta stocks. And so the fact that this ratio is declining is overall negative. And we look at an intraday chart of growth versus value, not really seeing much of an edge either way. Both have been getting hit pretty hard lately. What we want to see here to be more positive is the blue line to be above the red line. And they both can be going up, but we just want to see the blue line outperforming. Not really much of an edge here. And then we look at another intraday growth to value chart. This had been improving, where we're seeing growth outperforming value. That's more positive, and that's where we're seeing a bit of a bounce in the market. Well, it's not improving now, and it's continuing to go down. That's more negative. And then we are negative because the 50-period moving average is now crossed below the 200, and that is signaling a downtrend. And we're mixed here with the advanced decline line. We're still above the moving average based on price. We're below the moving average based on volume. I'm trading that more as negative. And we're still below the midpoint here with our short and intermediate term advanced decline ratio. The blue line is just barely above the midpoint. The red line, which is more intermediate term based on 39 days, that is still negative. And we're seeing a bit of an improvement here with the new highs, new lows. This looks internally into the S&P 500. but it's not any strength that's showing the improvement here. It's a lack of negative signals. We had just a massive increase in new lows, and those are contracting. And that's why our 5 period is trying to turn back up, and we're leveling off to trying to turn back up with our 10 period. We're not seeing much green here. What we need to see is not only these lines turning up, but seeing a lot more green than red. And that's not what we're seeing right now. Now, when we look at the trend, and I use the ADX to determine the condition of the trend, we're negative across the board. This is the short-term trend, which is days to weeks. And it actually shows that we're weakening. The ADX is the black line, and it's going down and it's below its moving average after giving us an extreme reading above 40. But this doesn't mean the trend's going away. It just means it's slowing down. And we've been consolidating a little bit more here lately and wondering, okay, are we going to continue to chop more or less sideways? That's one possibility. But we're negative in the short term because the red line is above the green line. The intermediate term trend, this is the one that I focus on the most. This is weeks to months. And we're still below the moving average here. We're still negative because the red line's above the green line. And the red line had gone way above 40. When any one of these lines goes above 40, we take note of that, and it's since dropped back, but we're still negative here. Then this is a weekly chart where we're actually in a confirmed trend because we're above 20 and we're above the moving average. That shows the longer term trend is getting stronger, and the longer term trend is negative because the red line, even though it's coming down slightly, is well above the green line. So longer term, we're looking more negative as well. And then I have 3 smart money indicators, and it depends on how you interpret this, whether it's positive or negative. We're right about at the red line here with the moving average. That's usually the line in the sand. If we're above the red line, it's positive. We're below it, that's negative. Well, sometimes that doesn't help us all that much. So then there's the boom indicator here, which measures what direction is the accumulation distribution actually going. When we're going down and below the moving average, that would be more negative. We've started to look more positive. Then we fell back and we're not quite back above the moving average yet. So I'm still treating that as negative. So there's a couple of different ways you can look at this chart. Positive, or you can still see it as negative. Then this is negative though. The Chaikin money flow, the histogram is going down, the red line's going down. That is negative. This is smart money indicator number 2. Smart money indicator number 3, the Chaikin oscillator is continuing to decline below its moving average and starting to drop below the midpoint. That's negative. So 2 out of 3 of our smart money indicators are clearly negative. Number 1, it's a matter of personal interpretation. And the vortex, the red line's above the green line. Even though the green line's improving, the red line's kind of going sideways. We still haven't crossed over positive yet. And I bring this up. This is the short-term trend, the way I measure it, based on 20 periods. And we're trying to bounce up here, but we're hitting the 20-period exponential moving average, and that's producing some overhead resistance. If we do start to go back up, we'll be watching these levels to see if they provide any more overhead resistance. But when you look at all the moving averages together, both the simple and exponential versions, we're below all of them right now. So that's clearly negative on all time frames. And we're far away from the 20-period moving average. This is the boom indicator. It says, uh-oh, we're far away from the 20 and the 50. And when we're below 0, that means we're negative against the 200. So this could end up being positive, but it could also drop down and be more negative. Because price has a tendency, once it gets too far away from the moving average, it has a tendency to move back to that moving average. And then this, I'm treating it as more negative because the last reading we had here were O's, and that means selling. But you can see where we're starting to build up a bit of a constant, it's just consolidating right here. And if that lasts for a while, what typically happens is the longer things consolidate sideways, the more powerful either the up move or the down move will be. And I know there's all these patterns and everything that people try to say, we're going to go up, we're going to go down. I've seen those pattern type of things be wrong just as much as they're right. I would rather use other charts to actually interpret whether we think this is going to be an up move or a down move. So just the fact that there are O's here, that's why it's on the negative side. And we're extreme negative, but we could still go lower when we look at the rate of change over 50 periods. That's where we take Thursday's close and we go back 50 trading periods before that, and then just where is the change coming from? And right now we are quite a bit lower here, but when we go below this pink line, that's often when we are extreme negative, and sometimes we see a bounce. We've been trying to bounce a few times here, but we haven't been able to get back above this -10 level. And we look at the parabolic SAR, and there's really no ambiguity to this chart. If the dots are on top, that's negative. If the dots are on bottom, that's positive. We're actually positive here with the parabolic SAR, with the dots underneath, but we're negative on the weekly chart. And I could have easily put this on the positive side, but this is one of our primary indicators on the daily side that is still holding up a little bit better. Momentum still negative overall. We're going sideways with our short-term oscillator, the slope. We're turning positive with the TSI, so we're seeing a bit of a contradiction in the short term. Improving with the MACD, crossing above its moving average, but we're right at the moving average with the PMO, slightly above the moving average with the PPO. So this is looking a little bit better. But our long-term oscillators, the TRIX and KST, this one's trying to turn up, the TRIX, but the KST continues to decline. So we're getting a really mixed picture here. Copic curve, another momentum oscillator, trying to stabilize and going sideways at a really extreme negative reading, but it hasn't come back and crossed above the red line. This is a long-term oscillator, the special K. We're below the red line and declining. That's negative. And then a week ago when I did this video, we were just a little bit above this red trend line. This is a trend line that goes all the way back to the 1987 crash. And, well, we were able to get right back up to the line. We're just a little bit below it right now. So that's slightly more negative. And then we're looking negative when we look at our advanced decline line studies. We're below all the moving averages here with all the different indexes. The one that's probably holding up the best right now would be the S&P. You can see the blue, the blue line here it's pretty much going sideways, where we're seeing declining moving averages with the other indexes. And so, yeah, it's holding up a bit better, but it's still below the moving average, which is making it negative. We're seeing a death cross now with the Dow. This was the last main index to start to show a negative trend. That happened after Thursday. United Healthcare came out with their earnings. They were not well received, and the Dow ended up going down enough. And it's been below both of these moving averages for quite some time. So now that's in a downtrend. The NASDAQ was one of the first of the major indexes to actually cross over negative. And we call that a death cross here when the blue line crosses below the red line. That's negative. NASDAQ 100, a more recent addition here, that's in a downtrend. Small caps, they were one of the first, probably the first index. The S&P 600 is in a downtrend. The Russell 2000 small caps, they're also in a downtrend. Mid caps are in a downtrend. Micro caps are in a downtrend. Everything is in downtrends. Not necessarily bear market, at least yet, but they are in downtrends. And then the Wilshire 5000, a broad market measure. We're seeing a death cross here, and we're seeing a recent death cross here with the total U.S. stock ETF. So all of these indexes are in downtrends. The financial sector is holding up a bit better. The reason why this is on the negative side is we're dropping below the 200-day moving average. We want this to do better, and that would really help the market. But it's holding up for right now. But the bank ETF, which is part of the financial sector, we're seeing a death cross there. And then we want to keep an eye on the small banks. They did bounce up a little bit on Thursday, but you see this ratio has really been going down when we look at regional banks to the financial sector. Now, the financial sector, as I just showed, has been under its own pressure. And then to have the regional banks doing even worse, that's when this ratio goes down. We want to see some improvement here, but for right now, it's negative. The FANG index, just hanging on. These are the big stocks: Facebook, Apple, Amazon, Netflix, Google, Nvidia. It's hanging on to an uptrend, but the longer we stay below both of these lines, the more we're going to see a death cross. And then we look at staples, which are more defensive, and that's what outperforms when the market's going down versus tech. That's what outperforms when the market's going up. We're going up with this ratio, meaning staples are outperforming tech. That's what happens when the market becomes more defensive. And then we look at the ratio between stocks and bonds. We're coming down into this area well below the rainbow, where for most of 2023 into 2024, we were above this rainbow. And when we're up in this area, that means the market thinks it will have a soft landing, meaning no recession. Well, now we're dropping down into this lower area, and the longer we stay down in this area, that means the market may be anticipating a hard landing, which means that there will be a recession. Then we look, this is just an inverse of the previous chart, showing how bonds are starting to outperform stocks. We haven't seen that in quite some time, but bonds are actually doing better. Home construction, it was one of the first areas to really turn weak back in 2024, and it's really going down when compared to 3 to 7 year bonds. Semiconductors, which are a huge part of tech, they are in a downtrend. And I have a lot of different semiconductor charts that show ETFs and indexes and the SOX index. I didn't want to show all of them because they're all negative right now. And this is a ratio of the semiconductors growth to the Dow, which is considered to be value. This ratio, and for quite some time, it's actually been going down and underperforming. And then semis are underperforming tech. Now, when the semis are outperforming and tech's doing well, that's when we see this ratio going up and we see the NASDAQ 100, the S&P 500. We see a lot more positive environment. When this ratio is going down, and not only is tech going down, but this ratio going down means that semis are going down even more. That makes it even more negative. Then we look at the S&P to utilities. When this ratio is going up, that means the S&P is outperforming utilities, which are usually considered to be defensive. Well, this ratio is going down, and so that's making the S&P more negative. And then same thing with staples, where we compared staples to tech earlier. This is staples to the S&P. When this ratio is going up, that means staples, toilet paper, toothpaste, are outperforming the S&P 500, and that is more negative. Then this is another thing, looking at staples, and this is a longer term look at what was happening at the end of 2021. Well, we saw the SPY, which is the ETF for the S&P 500, to staples ratio. It topped out and then started to come down. If you remember back, we set the all-time high for the S&P in January of 2022. This started to roll over in late 2021. So this was giving us a bit of a heads up, and then we went into a bear market that lasted through most of 2022. Are we seeing a similar thing to that now? We topped it with this ratio and then started to go down, and then that was in January, and then in February is when the S&P set its all-time high, its most recent one, and now that's under pressure. And is this telling us that things are going to get worse from here? We don't know that. We'll just follow it on a day-by-day basis, but in times not so far past, this ratio going down also really took the stock market down with it. We're wondering if that's going to be continuing to happen here. And we look at a long-term weekly chart of the NASDAQ 100 going back to 2009. We're continuing to drop further below this trend line here, and that's more negative. And then the areas we're just watching. Now, this is holding up for right now. The weekly jobless claims, they actually went down in the latest reading, and that's good. That means employment's holding up, and that means that it's less likely that we're going to go into a recession. But if we start to see these charts really go up, meaning jobless claims are going up, people are getting laid off, then that's going to probably mean we're going into a recession. But we don't know when or even if that's going to happen. Right now, this is hanging in there pretty well. And then we look at the continuing claims, which are not falling, but they're not really rising. They've been more range bound so far going back into 2024, and we're just getting to the upper end of this range. So if this really starts to shoot up and the blue line starts to go up, that'll be more negative. And this just plots everything together. The red line are the initial claims, the blue line, that's the continuing claims, and then the latest unemployment rate. We want to keep an eye on interest rates. Now, a week ago, we were all freaked out because interest rates were just shooting up really fast. They climbed 0.5% in 1 week. We are settling down a little bit, but that could change back and they could start to go up. That would be more negative. If they continue to go down, that might give some support for stocks. And then we want to try to get an idea. What does the market think about inflation? Now, there's a lot of people freaking out about inflation fears down the road, and it may end up happening. But what's the market saying about that? And there's a number of different ways we can look at this. This looks at cash and compares it with 3 to 7 year bonds. When this ratio is going up, that means that the market is concerned about uncertainty, economic uncertainty, and they're concerned about inflation going up, and they're concerned about interest rates going up. Well, see how we've been coming down? Now, We went up a week ago. That's because interest rates were just freaking out and going to the upside. But this past week, it's starting to come back down. We're still in an uptrend, but the blue line's really coming down. If this continues to fall, that would mean on a short-term basis, the market's not really worried about inflation or interest rates. So let's look at some other charts. Let's look at TIPS, which are Treasury inflation protected securities. This is what folks get into when they're concerned about inflation going up and interest rates going up. And then we see this ratio going up when that happens. Well, what's the ratio doing now? It's actually going down. So that means that according to this, there's not a lot of concern about inflation and interest rates in the market. So let's look at further out bonds. Let's look at TIPS again, but instead of 3 to 7 year bonds, let's look at 7 to 10 year bonds. It's chopping around, but it's definitely not going up right now, meaning there's not a lot of fear here. And then we do want to keep an eye on the 10 to the 3 month yield curve. Now, most people follow the 10 to the 2 year yield curve, and that's doing fine. That's not inverted right now. Well, we've been seeing the 10 to the 3 month yield curve. It comes down, it goes inverted, then it doesn't, then it goes inverted. Right now, it's not inverted, barely. But this is when we start to do a countdown, and we don't really know. It can be 3 months, it could be 6 months, it could be a year, it could be 18 months. This is when we typically start a countdown back when it goes to looking normal again to say, okay, we're going to go into a recession. We already started the countdown before, and this was going back to looking normal, but then we went back to being inverted again. And so we kind of have to restart the countdown now. And then we're keeping an eye on this mainly for sentiment reasons. This is the spread between risky bonds like junk bonds and not as risky bonds like high grade corporate bonds and even government bonds. When this is going down, that means fear is increasing. And that's what we've been seeing. Well, we've been coming back up a little bit here. So this is still a pretty low reading and not really low from what we saw before. This could go down a lot lower, and this was back into 2022, but it is improving a little bit. But we mainly watch this to try to gauge what is the sentiment of the bond market. Is it more positive? Is it more negative? We do want to keep an eye on oil. It did go up. It's more in the mid 60s now, where it had been in the lower 60s. We just want to keep an eye on this one. And then the dollar, we're now seeing both on the daily side and then on the weekly charts, we are in a downtrend. We've seen a death cross here, and we're seeing a death cross on the weekly chart, and we're dropping below 100, which kind of goes against what you would think should be happening with all the tariff talks. What was really pushing the dollar up was, yeah, we're going to do tariffs. We're going to do tariffs. That tends to increase a currency's value for a particular country. Well, lately, this has really been coming down. There's speculation. Is this being manipulated to go down? Is this a way to try to have control, with the US having control over other countries because they, like China and Japan, they have a lot of US Treasury bonds. And if we devalue our own currency and they peg their currency to our currency, that means that they're paying us back, but it's like the debt is being decreased. It's devaluing the debt itself. And we don't know. The official stance of the US government is to have a strong dollar. The unofficial stance is that the US government wants to have a weaker dollar. That tends to help things and make it more maneuverable. Thank you. I really hope you found this helpful. I hope you're having a wonderful Easter weekend, and I will talk to you in the next video.